36 trillion US dollars. This is not the gross domestic product of the United States, nor the total market value of each company in the S&P 500 index, but the amount currently owed by the US government, which is still rising at this moment. Most people are completely wrong about this number, and this misunderstanding has cost them, because this debt directly affects your mortgage interest rates, your retirement account, and the stability of the entire global financial system. The problem here is not just how big the debt is. Who is taking responsibility, and what happens when they start giving up debt, are the truly important questions. Please, stay with me in the next 20 minutes, because in the end, you will know more about the Treasury bond market than 95% of the people on Wall Street. This channel reports on how wealthy people truly understand money, rather than a diluted version. Today, we will discuss Treasury bonds in depth. The U.S. Treasury bond market is the largest bond market in the world. When it falls into serious difficulties, the entire global financial system will feel the impact. In the past 15 years, the U.S. Treasury bond market has been in serious trouble at least twice. Today, we will discuss 4 things. First of all, what is Treasury bond and why most people confuse it with other types of government debt. Secondly, the size of this market and how to segment it in a truly meaningful way. Thirdly, who holds all these bonds and why this answer keeps finance ministers in Tokyo, Beijing, and London up at night. Fourthly, why are the events of 2023, 2024, and 2025 a truly new and more dangerous phase for this market? Starting from the basics. Without it, other content in this video will not be able to land in the way it should. When the federal government has spent more than taxes in 23 of the past 25 years, it will borrow the balance by issuing Treasury bond. Imagine that they are IS sold by the government to investors. If you lend money to the government, it will pay you interest over time and eventually repay the principal. The concept of cleanliness has enormous consequences. Not all Treasury bond operates in the same way, and the difference is more important than most people realize. Treasury bond, also known as Treasury bonds, is a short-term instrument with maturities ranging from 4 weeks to 52 weeks. They are purchased at a discounted price, redeemed at face value, and do not require regular interest payments. Only the difference between the purchase price and redemption price needs to be paid. Medium-term Treasury bond includes 2-year, 3-year, 5-year, 7-year, and 10-year Treasury bond. Interest is paid every 6 months, which is called coupon payment. These constitute the pillars of the entire Treasury bond market. When the financial news mentioned that the yield of 10-year Treasury bond reached 4.5%, they meant Treasury bond. Treasury bond is the core tool of today's discussion. It is located at the long end of the curve. The term is 20 years and 30 years, and the coupon is paid every 6 months. Its sensitivity to long-term inflation expectations and Federal Reserve policies makes it the most politically and financially burdensome security in the market. Tips. That is, inflation-protected Treasury bond with inflation-adjusted principal and floating rate notes launched only in 2014 have improved the product line. But notes and bonds bear the market. This is where people are caught off guard when they first solved this problem. The term Treasury bond is often used as a general term for all U.S. government debt. Technically, Treasury bond only refers to long-term bonds, i.e., 20 to 30-year bonds. Long-term bonds are the most interesting and dangerous dynamic at present. In 2025, the details of outstanding sellable Treasury bond are as follows. The largest share of U.S. Treasury bonds is about 40 to 45%. The rise of Treasury bonds has reached a historical high of 22 to 25%, which is not accidental and will soon recover. 20-year and 30-year Treasury bond account for about 12 to 15%. TIPS accounts for about 7 to 9%. And the rest are floating rate bonds. The T-bill numbers exceeding the suggested range illustrate the current strategy and vulnerability of the Ministry of Finance, which is a story worth paying attention to. $36 trillion has lost its meaning to some extent, so it has been placed next to numbers that are easier to remember. The gross domestic product of the United States, that is, the total annual economic output of the country, is about $28 to $29 trillion, which means that Treasury bond now exceeds the annual economic output of the United States, making the ratio of debt to GDP more than 120%. Economists Carmen Reinhart and Kenneth Rogoff believe that the historical level associated with economic slowdown is 90%, and the United States broke this threshold a few years ago. The total market value of each company in the S&P 500 index is about $45 to $50 trillion. So Treasury bond accounts for about 3/4 of the entire index. China's gross domestic product is about 18 trillion yuan. Japan's is about 4 trillion yuan. Germany's is about 4.5 trillion yuan. And the total economic output of the entire Eurozone is about 15 trillion yuan, which means that the debt of the United States alone exceeds all debt. According to SIFMA data, the daily trading volume of U.S. Treasury bonds usually exceeds 900 billion to 1 trillion US dollars, which is not misspelled. Every day, more than $1 trillion of U.S. Treasury bond change hands during active trading hours, making it the largest and most liquid sovereign bond market on the earth. The depth of this liquidity is precisely why U.S. Treasury bond are called risk-free interest rates, which is the benchmark for measuring all other investments in the world. The historical timeline of this debt is as important as its current level, as its growth rate tells a story that cannot be conveyed solely through snapshot numbers. When Alexander Hamilton constructed the first consolidated federal debt in the United States in 1790, it was one of the most important financial decisions in the country's history, totaling approximately $75 million, which Hamilton referred to as the blessing of the nation, the foundation of credit and commerce. During the Civil War, the debt exceeded $1 billion. In 1981, during the Reagan administration, the first $1 trillion was repaid, which caused a real panic at the time and broke through $10 trillion before and after the 2008 financial crisis. Then came COVID-19. The Nursing Act alone was passed in March 2020, within a few days, and the $2.2 trillion package and subsequent relief plan added about $4 to $5 trillion in debt over approximately 18 months. the fastest period of debt accumulation in U.S. peacetime history. After that, the track never turned again. Interest expenses are where numbers become truly contradictory. In fiscal year 2024, net interest payments on federal debt will approach $870 billion to $900 billion. And the Congressional Budget Office predicts that this number will exceed $1 trillion annually around 2025 or 2026. This crossover means spending over $1 trillion annually to repay borrowed costs without the need to build anything, without defense funding, without providing health care, only interest. In recent years, the entire defense budget of the United States has been around $800 billion to $900 billion, which means that debt interest is now comparable to the Pentagon's budget and is expected to pass. As a part of the gross domestic product, interest payments are close to 3%减 3.4%, which was the last level that appeared in the last serious fiscal settlement dialogue in the early 1990s in the United States. Most financial reports skip this section within 30 seconds and then continue, which is a mistake, because the ownership structure of this debt is where financial and geopolitical conflicts arise. And this conflict intensifies every year, starting from the Federal Reserve. At the peak of quantitative easing policy in 2022, the Federal Reserve holds about $5.7 trillion of Treasury bond, which means that the U.S. Central Bank owns about 20% of government debt, which is the direct result of the 2 rounds of major asset purchases after 2008 and the large-scale epidemic period in 2020. Since June 2022, the quantitative tightening policy has reduced this number to about $4.3 trillion to $4.5 trillion by the middle of 2025, so that the U.S. Treasury bond bonds up to $60 billion per month can be issued without reinvestment. Every dollar that the Federal Reserve stops reinvesting is a dollar that others must buy, and others, whether domestic private investors or foreign governments, are demanding increasingly higher yields to purchase these bonds. The assets held within the U.S. government caught people off guard when they first encountered them. The total amount of Treasury bond owed by the government to the government is about $7 to $7.5 trillion, especially Treasury bond owed to government trust funds, of which Treasury bond held by Social Security trust funds is the largest, about $2.7 to $2.8 trillion. For decades, the amount collected by Social Security and payroll tax has exceeded the amount paid in welfare. Surplus is invested by purchasing Treasury bond. The government spent the money and left the IOU in the trust fund. Now, with the aging population driving Social Security expenditures to exceed income, these bonds are being redeemed, directly increasing the real-time net financing demand off the Ministry of Finance. By 2024, foreign and international investors will hold about $7.5 to $8 trillion of U.S. Treasury bond, accounting for about 25 to 30% of public debt. Although this proportion has decreased compared to 10 years ago, the absolute number is still huge, and its composition has serious geopolitical significance. Japan ranks first on the list of foreign holders, holding approximately $1.5 trillion, including currency management, reserve asset requirements, and arbitrage trading dynamics between the Japanese yen and the US dollar. When the Bank of Japan began to adjust its yield curve control policy in 2023 and 2024, it raised a real question, that is, whether Japanese investors would repatriate capital and withdraw their demand for US Treasury bonds. These concerns directly led to long-term yield fluctuations in this period. The Chinese side's position is of the greatest concern and has sufficient reasons. During the peak period from 2013 to 2014, Beijing controlled about $1.3 trillion of U.S. Treasury bonds. By 2024, this number will decrease to approximately $77.5 billion to $800 billion US dollars as China turns to gold, establishes bilateral RMB trade settlements, and expands its efforts to de-dollarize through BRICS countries. This is a carefully considered and orderly reduction. The significance of this exit is more profound than the headline numbers. For decades, China's arrangement to maintain a huge trade surplus with the United States and reinvest these dollars in U.S. Treasury bonds has been one of the key demand pillars to reduce the U.S. borrowing costs. And this pillar is weakening year by year with the withdrawal of the Federal Reserve and the fluctuation of foreign demand. Domestic private sector holders, pension funds, insurance companies, banks, money market funds, and individual retail investors in the United States have absorbed more and more new Treasury bond. Pension funds and insurance companies have a structural preference for long-term Treasury bond because they need to match long-term debt. But this demand is not unlimited, and they will be sensitive to price after exceeding a certain level. What is worth mentioning here is hedge funds, especially because of a kind of thing called Treasury bond basis transaction, which is increasingly concerned by regulators such as the Financial Stability Supervision Commission and the Bank for International Settlements. This kind of transaction is realized by making use of the small price difference between Treasury bond, cash bonds, and Treasury bond futures contracts. The price difference is so small that funds need to be heavily leveraged. Sometimes the leverage ratio is 50 to 100 times to generate meaningful returns. By 2024, it is expected that hedge funds' exposure in this transaction will be between $500 billion and $800 billion. And under normal circumstances, arbitrage activities will quietly hide behind the scenes. What happened in March 2020 was not normal. In that year, the forced liquidation of similar positions led to serious chaos in the Treasury bond market. As the ultimate buyer, the Federal Reserve intervened to prevent a self-reinforcing collapse in prices. The current concern is that since then, the scale of trade has grown significantly, and the next shock may be harder to absorb. So far, everything covered has provided background for the changes in the market since 2022, which are different in nature from normal interest rate cycle changes and more like a structural repricing of U.S. fiscal risks. From March 2022 to July 2023, the Federal Reserve raised its benchmark interest rate from essentially 0 to 5.25% to 5.50%, marking the most aggressive tightening cycle in over 40 years. In October 2023, the yield of 30-year Treasury bond will climb from less than 2% to about 5.0% to 5.1%, which is the level never seen since 2007. This interest rate change exposes the vulnerability that the Ministry of Finance has been quietly accumulating for many years. In the era of COVID-19, ultra-low interest rate the Ministry of Finance issued a large number of short-term bonds, keeping the weighted average maturity short and obtaining cheap financing available at present. This is similar to the instinct that leads households to choose adjustable rate mortgages, as introducing interest rates may seem attractive, but also carries the same risks. When interest rates rise sharply like they do now, every Treasury bill that matures and needs to be extended will be refinancing at a higher interest rate. And this refinancing spiral is the direct cause of interest expenses soaring to $1 trillion per year. In the past 12 years or so, the U.S. debt has experienced 2 sovereign credit downgrades, but neither has received due attention. In August 2011, Standard & Poor's downgraded the rating of the United States from AAA to AA, marking the first downgrade in U.S. history. This was triggered by the debt ceiling deadlock that summer, but stems from deeper concerns about fiscal management. Fitch Ratings was subsequently downgraded to AAA. In August 2023, Treasury Secretary Janet Yellen publicly rejected this decision, calling it arbitrary and based on outdated data. Fitch's written reasons point out that governance erosion, recurring debt ceiling edge markers, and the deteriorating fiscal trajectory, supported by numbers, continue to worsen. The last AAA rating of U.S. debt by Moody's will last until 2025. When this video is released, the status of this rating deserves independent verification. There is a little known story about the 20-year Treasury bond, which reveals the limitations of the Ministry of Finance's ability to generate demand due to the failure to generate sufficient market interest relative to 30 years. The plan was terminated in January 1986 and resumed on May 20, 2020, particularly to assist the Ministry of Finance in extending its average debt maturity and locking in financing at historically low interest rates. The result is not quite what the Ministry of Finance had hoped for. The reissued 20-year bond has been trading at a discounted price, which means investors are demanding a slightly higher yield than the mathematical forecast for the 30-year bond. This is a quiet but persistent signal that the market will only accept this tool on its own terms. Bond volunteer army is a term coined by economist Ed Yardeni in the 1980s to describe investors who constrain financially irresponsible governments by selling bonds and increasing yields. In the 2010s, when years of massive deficit spending seemed to have little response to long-term interest rates, bond vigilantes were widely declared dead, mainly because the Federal Reserve's asset purchases effectively suppressed yields. In October 2023, over a period of 30 years, this number soared to 5%, sending a clear message that this era of repression has come to an end. This is a signal from the bond market that in non-recessionary economies, an annual deficit of $1.5 trillion to $2 trillion will come at a tangible cost. The suspended issuance of Treasury bond has recovered to the earlier data point on the increase of short-term issuance. The Borrowing Advisory Committee of the Ministry of Finance suggested that Treasury bonds should be kept at about 15 to 20% of the total debt available for sale, because exceeding this range would lead to a very specific and direct risk of refinancing concentration. The maturity of Treasury bond is fast and must be continuously postponed. Therefore, when market conditions deteriorate, when money market funds face redemption. Weak foreign demand, or the Federal Reserve is in a tightening mode. A wall of maturing short-term debt now needs buyers. Not the ultimate buyers. The Ministry of Finance has been sending signals to shift towards long-term bonds to reduce the risk of extension. But doing so means issuing more 20 to 30-year bonds at the current yield of 4.3% to 4.8%, locking in expensive and unlikely temporary financing costs. What everyone pays close attention to is the 30-year mortgage interest rate, which changes with the yield of 30-year Treasury bond. And this relationship will remain unchanged over time. At the beginning of 2020, when the yield of 30-year Treasury bond is close to 1%, the 30-year mortgage interest rate will fall to 2.6%, the lowest level in history. By the end of 2023, when the yield of US Treasury bonds approaches 5%, the mortgage interest rate will exceed 8% in some cases. Every change in the yield of US Treasury bonds will affect the cost of mortgages, the company's borrowing rate, the pricing of auto loans, and the discount rate used by each U.S. CFO when deciding whether to invest in the enterprise or return capital to shareholders. The size and health of the U.S. Treasury bond market are the basis for the country to make every financial decision. Pull it together. The size of the U.S. Treasury bond market is $36 trillion. And it is still growing. It is the world's largest and most liquid sovereign bond market, with a daily trading volume exceeding $1 trillion. The yield curve sets the pricing benchmark for almost all other existing financial assets. The structure of who holds this market, under what conditions, and at what interest rates is changing in a way that does not have a truly modern equivalent. The Federal Reserve has been withdrawing from this role after suppressing long-term returns through asset purchases for 15 years. Under the leadership of China's plan to abandon US dollar assets, foreign holders have been reducing their share of total assets. The positions of hedge funds in basis trading are at a level of concern for regulatory oversight of systemic risk. In an environment where borrowing costs far exceed the seemingly controllable intergenerational lows of debt accumulation. Over the past decade, the Treasury Department itself is funding an annual deficit of $1.8 trillion to $2 trillion. The annual interest expense of over $1 trillion is not just a number. It shortens the time for serious national dialogue about income, expenses, and growth. Either income increases, expenditure decreases, and growth accelerates significantly, or the combination of the three narrows the gap. There is no other method that does not involve inflation that ultimately erodes the real value of debt, just like a tax levied on every dollar holder. None of this means that the Treasury bond market is about to collapse. Undoubtedly, in March 2020, the US dollar remained the world's reserve currency. In a real crisis, US Treasury bonds are still the default safe haven. Assets of global capital. The demand for pension funds, insurance companies, foreign central banks holding US dollar reserves, and US retail investors through Treasury Direct remains real and enormous. This does mean that the environment of higher returns, higher costs, and higher risks for US government borrowing is now an operational reality rather than a temporary situation. The decisions made on how to finance the federal government. What kind of maturing bonds to issue? At what speed? And under what fiscal background will shape the financial environment in which every viewer of this video will live and invest for at least the next decade. Ignoring the Treasury bond market means turning a blind eye to the most important financial instruments in the world. That is the story. This is the actual meaning of $36 trillion.